Welcome to the daily update, where I'll go over the action in the market for Friday, November 1st, and then we'll see how things look for Monday, November 4th. Well, we had that big down day on a relative basis on Thursday. We broke through the 20-period moving average, but we closed right at the 50-period moving average. We bounced up on Friday, but we gave back a lot of those gains as we worked our way to the close. So we really haven't changed the situation. But the intermediate term remains positive because we're above the 50-day moving average. But a lot of our indicators have switched over and we're looking more negative now, especially in the short term. We haven't quite switched over to the intermediate term negative unless we close below the 50-day moving average. We've got a lot of variables out there. We had the employment situation report that is known now, so that's not a variable, but it came in way, way weaker than expected. That pretty much has suggested that the Fed will come in and cut rates another 25 basis points on November 7th. Now they're meeting a couple of days later, this time because of the election, which will be on Tuesday, November 5th, which is another big variable out there. Not only who's going to win, but what is the reaction going to be no matter who wins. And then you've got, of course, things in the Middle East, which really are not in the major US news cycle right now, even though things are really happening there. That could come into the picture at any time as well. Okay, so I have a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. One of the benefits is you get access to the videos that I post right after they're available, where I delay those on YouTube and Rumble. You can email me if you have any questions. There's a link that'll take you to the website, a link that'll take you to the video to learn more about the program. Feel free to check that out and see if it's of interest to you. Also, this video right here, the daily video, this is for Monday's session, but over the weekend, I'll be preparing all the outside videos. They're meant to tie into the daily video. That's the real foundation of the analysis that I do. All right, let's go back and talk about what happened. We had a higher open. The futures were positive, and Europe was up, and we got some strength from that. And so the futures were showing some improvement. And then the economic reports came out, and nothing really changed. There was really no reaction to it. So we held on to those gains, and then that led to a higher open because we're still above that 50-day moving average, and that's pretty significant. We opened above the daily pivot at 57.28. We got above R1 at 57.53, but we didn't quite get up to 57.75, a round number. We never got up to R2, so that's not here on the list or on the chart, but we were just underneath that 57.75 level. Then we chopped above R1. Just, it's like everything ran out of steam. They thought everything was going to bounce right up. Well, it did at the open, but then it just became more exhausted. We stayed above R1, but then we fell down below R1 and we closed pretty much at the daily pivot. So we gave back a lot of those gains. We were still positive though. We were up 0.41% on above average volume. So we are negative in the short term, still positive in the intermediate term, and still positive in the long term. And this, as far as interest rates are concerned, pretty much locks in a rate cut, at least according to the market. There's like a 98% chance. And I'll be going through those charts in the weekend videos. Inflation still seems not as tame as the market would like, and not as much as the Fed would like, but it's still coming down from where it had been originally. We want to keep an eye on all the geopolitical things happening in the US with the election, because those could escalate. There's always that fear that something big could happen leading up to the election, and then, of course, on the election day, and then something could happen after. So you've got a lot of folks really on edge wondering what's going to happen with all of that. Some comments. The jobs report that came out, it was much, much weaker than expected. And I'll go through the numbers and show you. And also the ISM manufacturing, that's a major report too. It was also weaker than expected. The 50-period moving averages are holding for now. Now, the reason I have this plural is there's a simple and exponential moving average on the chart that I'll show you later. We're coming down a little bit with the VIX, but we're still above 20. We were at 23 after Thursday. We came down under 22 after Friday. We're keeping an eye on the Middle East. Oil's not really reacting all that much. It's been camped right around the $69 level. We had a couple of things taken off of our short-term extreme negative list, but we still have the usual charts that are there. The Stochc RSI, the Williams percent R, the CCI 14 and 20, and the stochastics. And intermediate term, we still have that 10-period new high, new low. It's coming down. It's just barely hanging on to extreme positive right now. Any more weakness, and that would probably drop off the list here. And we're already oversold. We have the Chaikin oscillator. This is one of the smart money indicators. They have switched over decidedly negative now, with the Chaikin oscillator being extreme negative, and we're extreme negative with the McClellan oscillator for the S&P 500. What I changed here is that, okay, the Fed's already come in and cut rates 0.5% one time. It still looks like we could have a soft landing, but now this 25 basis point cut, or 0.25%, it's pretty much anticipated now that that will happen on November 7th. The dollar was up and interest rates were up. We're up at 4.36% with the 10-year yield, where we had been at 4.28%. We're still inverted with the 10 to the 3-month, even though it's getting closer. And I'll show that probably over the weekend in one of the weekly videos. But we're still inverted there, where we're uninverted or back to regular with the 10 to the 2-year yield curve. Sentiment is neutral. We'd actually ticked down into negative territory after Thursday. With the slight bounce that we saw, we're back up at 49, which is neutral, where we had been at 44. We are negative with our trend. The red line crossed above the green line on Thursday. It's still that way. The red line came down a little bit, but the green line's really not going up. We're still in a weakening trending environment because we're below the moving average. The ADX is declining, but we are still in a trending environment because the ADX itself is still above 20. With the up day, the bias is positive, but I'm still keeping the momentum at negative. We have really switched over negative, especially in the short term for right now. Economic reports that came out. Non-farm payrolls. They thought 120,000 new jobs were going to be added. 12,000 was added. I actually had to do a double take on that and check it with another source. It's like, my goodness, is that it? My. And last time we had 223,000, and that was revised down from the 254,000 that they first told us. So we're seeing some weakness now in the employment situation. This does bode for a rate cut, but we saw stronger than expected employment information earlier in the week with jobless claims and ADP and the different reports that we look at. This one was much, much weaker than expected. We actually saw negative payrolls for the private, non-farm private payrolls, down 28,000. They expected it to be up 105,000. And this was revised down too. The first time we got this number, it was at 223,000. They revised it down to 192,000. Average hourly earnings were actually up a little bit, up 0.4%, and more than the 0.3% they had expected. Last time it did come in at 0.3%. The unemployment rate was unchanged at 4.1%. The average work week was 34.3, a tick up from the 34.2 we saw last time, and also the same reading that we did have last time. We also had the S&P Global US Manufacturing PMI. The takeaway from this, and I don't show a chart, we just look at this number, and if it's above 50, that shows expansion. Well, we're coming in below 50 at 48.5. That's showing a contraction in the global economy, but it's up from the 47.8 that we saw last time. Construction spending was up 0.1%. They expected it to be unchanged. Last time it was also up 0.1%. The other kind of big report was the ISM manufacturing, came in at 46.5. Notice that's below 50, and it was weaker than expected. They thought it was going to come in at 47.6. It's also down from the 47.2 that we saw last time. Okay, so here's some charts. I don't show the jobs charts because it still takes into account 2020 with all the lockdowns, and that chart is so skewed, it's almost useless. but the earnings year over year are going up just a little bit, right around the 4% level on a year over year basis. Here's the change where we were positive, but we really dropped off, and it was a lot weaker than expected. Construction spending declining a little bit, just under 5% on a year over year basis. And then you break it out looking at the year over year with residential pretty much flat, and we're coming up to flat with the non-residential construction spending. Month over month, it was still positive, but a little bit lower than the previous reading. The ISM index, we are flat right now and below 50. This is showing contraction with manufacturing here with the blue line, and we actually declined just a little bit with the orders, also below 50. The prices and deliveries. Prices were pretty much flat from the previous reading. Deliveries were also flat. The ISM trade. We look at exports, which were flat. That's the blue line. Imports were also flat. So we didn't really see much of a change in this particular report. And then the ISM index itself, just not much of a change from the previous reading. So here's Isabel Net. Now, this chart is a variation of the chart that I show over the weekend. I go through the Robert Shiller PE ratio. That's also called CAPE, C-A-P-E. Real Investment Advice posted this chart at Isabel Net, and it just shows you this is the overall trend that we're seeing of valuations as we're going higher. And if we're above this, that means we're above the exponential growth trend here. And that's where we're at right now. This is still suggesting that the market is overvalued at this point. And then the black line here is the cyclically adjusted PE ratio, the Robert Shiller version of the PE ratio. Then U.S. heavy truck sales going up just a little bit, showing some stronger sales. That could bode better for the economy. Quarterly margins, folks, we've been going up here with money that companies are out there spending just to operate things. And according to Deutsche Bank here, they predict that that will actually continue to go up, and that could be better for the economy. Gold, of course, here, this is what a lot of people are talking about this, but at this point, they're not really outperforming stocks. If you had been in the S&P, you'd be performing pretty well. If you had been in gold lately, you'd be performing well. I'll go over these charts over the weekend, but there's really not much of an edge with either one right now. But looking out, the realize that's the dark blue line. The futures think that it's still going to go up, but not as much as the Goldman Sachs forecast. They think gold is going to go up to 3,000 here. Who knows what's really going to happen? But people love forecasts, even though I personally don't forecast. My approach to technical analysis is we just look at the charts and go with what they're telling us right now. And if they're positive, then the probabilities are we're going to stay positive. If we're switching negative, then the probability is that we'll stay negative until proven otherwise. Mutual fund performance. Now, ETFs are the real big thing these days, but there's still a lot of folks. There's still major amounts of money that are in mutual funds right now. And this is the year-to-date return with the large cap doing the best and large cap growth doing even better than that. Value has actually been performing quite well on a year-to-date basis here, but this is a good solid return, a 20%, or I guess they're going around the 20% here, but 18.5%. That's very respectable to this point. We'll see, can the market add to those gains as we go into the end of the year, or are some of those gains going to be taken away? I did find one interesting chart. Now, one of the kind of critics of indexes is that, well, you can't really trust the index because they take out the garbage stocks and put in good stocks. I like that. That's why I focus on the S&P. I know there's quality built into the index. And if there's some dogs in the S&P 500, I want them thrown out and I want them replaced by other stocks. Well, the editorial board and committee that decides which stocks are in the Dow, they've decided that they're going to take Intel out of the Dow and they're going to put NVIDIA in the Dow. So I'm not quite sure when that, let's see, the last change in February. I'm not sure when this is actually going to take place, but this will help boost the Dow and give it a little bit more performance. And I remember when Intel went into the Dow, they were one of the first stocks with Microsoft that was a NASDAQ stock that they put into the Dow. They used to just have NYSE stocks that were included there, and it was all a big deal. Well, Intel isn't the darling that it used to be, and their stock is down. They just haven't been doing well. They didn't really get on the whole AI thing like a lot of other companies have done. Back when Nvidia first came out, I mainly knew them as for their graphics cards, and now they've gone over into AI and their processors and things like that. But just thought this was kind of interesting. And that's what they do. They take out a stock that's not performing all that well and they put another one in there that is. You notice now in the Dow, if you look through the 30 list, there's not a single car manufacturer in there. Where that's what really built the middle class in America. Now they're not even included in the Dow. All right, let's go back and look at the chart here. Here's the big down day that we saw on Thursday, and a lot of those losses were seen at the gap lower, and we just kept going down. We closed down at S4, which rarely happens. Well, we did see a bounce. This S4 is right at the 50-day moving average on the daily chart. So the futures were looking better. We got a higher open. We got above R1, and we stalled out just under this 57.75 level. And that's where things started to look a little bit exhausted. We started to drift sideways and then lower. We went down below R1. We just about made it down to the daily pivot. Tried a little bit of a bounce going into the close, but that didn't really have any strength behind it. So then we ended up closing down just about at the daily pivot. And here's the intraday chart. You can see that there was much of an improvement with the futures from Thursday to Friday here, and that's where a lot of the strength came from. We set the high near the open and then spent the rest of the day actually going down after that. This is still somewhat positive, even though they're declining with the blue line and the red line. The blue line is still above the red line. That means on an intraday basis, even though they're on different scales, growth, large cap growth is outperforming large cap value. And here is the growth to value ratio where it did show some improvement. We had been looking more positive here, and this is when the short-term trend was still positive. This was going up. Well, then we had that down day on Thursday, and growth just got hammered. It bounced back up a little bit here, but we're going to need to see more follow through for this to turn back more positive. If it continues to decline, of course, that would likely be more negative. So growth was up, and it was up more than value, where value was virtually unchanged. We had the mid cap growth was up more than mid cap value, and it was also up more for the small caps. And so we're just kind of chopping around, but still in a downtrend. When we look at small cap growth to value, mid cap growth to value, still in a downtrend. Large cap growth to value still in an uptrend here, but we're pretty much flat here from Thursday to Friday, holding on for right now. But we want this to go up if we're more positive. If this continues to go down, then that would be more negative for the S&P. Saw a little bit of an improvement between the growth and value ETF here. We'd come down into about the middle of the rainbow. Now we're coming back up to the top end of the rainbow. Nothing that really shifted from negative to positive, but we did see an improvement. And we were pretty much flat here with discretionary to staples, where discretionary Amazon was very positive, and that helped the discretionary sector, where staples have been under pressure lately, and that's really where this ratio is getting its strength from right now. Tesla did well and Amazon did well, so that's helping overall. And we're seeing an improvement here and holding on to this with the discretionary to staples ratio. Large cap growth was up, but still above its 50-day moving average, but well off of the highs. Looking at our trend, we are negative. The red line's above the green line. That switched on Thursday, or I should say after the close on Thursday, it switched from positive to negative. Even though we came down a little bit with the red line, we're still in a weakening trend because the ADX is below its moving average, but we are above 20, so we are still in a trending environment. Short term, seeing pretty much that same thing. We are starting to turn up a little bit here, but we're still below the moving average. The red line is above the green line. So we are negative in the short term. And the reason I'm not negative in the intermediate term is we're still above the 50-day moving average. We could turn negative in the intermediate term based on this chart, but I like to use other charts to reach that consensus that we're turning more negative, where we are negative here in the short term because we're below the 20-day moving average. We are still above average with volume. So that just shows a little bit more conviction going on here. This is the euphoria meter here. It's like a composite where it takes the forward PE, the VIX, and bullish sentiment and puts them all together. Now, I don't know when this chart was actually generated, but it's probably come down a little bit after Thursday's decline. But we're getting up above this one reading right now, which just means that from a sentiment basis, folks were getting a little too complacent and just assuming that the market was going to go higher. The Ulcer Index haven't showed this in a while. Usually I don't when we're below the moving average. Now, this is more on a closing basis, and this was designed a long time ago, mainly for mutual funds that only have a closing value. We're slowly starting to come back above the moving average as we're seeing fears start to increase. And the VIX did decline, but we're still well above 20. We're getting a very high reading here. And when we're up at 20 or above, that's where we see the negative annualized returns. We came down just a little bit too, but closed well off of the low with the bar chart. And when the VIX goes down, the VIX of the VIX also goes down, both with the bar chart and the line chart. The momentum of the VIX continues to be up. It switched up after Thursday's session. And so now the VIX overall is seeing an upward momentum. And here's the seasonality. Hasn't been updated for a few days. We're probably getting higher up into this area when we get into the first part of November. The skew index is still up in this red area. So not only are we getting a high reading from the VIX, the skew index, which is calculated using out of the money options, where the VIX uses at the money options, it didn't really move. It ticked down just a little bit, but the market is still expecting some kind of a big move. Maybe it's election related there. And we went up with this fear gauge, which the actual VIX went down, and we went down with this other fear gauge. So we're seeing a little bit of contradiction now with some of our sentiment indicators. Volatility risk premium did go back up here. We're still getting a very high reading. That's just anticipating risk forecasting out into the next 30 days. We're going up with the equity put call ratio. Now, you could have a lot of folks that are doing some hedging, so they're buying some puts to protect their long positions ahead of the weekend that's right before the election in case anything weird happens. And we might see this continue to go up as well because there's so much unknowns with what's going to happen. A lot of investors just want to be safe and make sure they're hedged in case we really start screaming to the downside. We're going up with the 5-day chart, and after ticking down, we're actually starting to go back up with the 10-day chart too. So this is more negative. This just shows that there's more hedging, more fear in the market right now. The advanced decline line showing a little bit of weakness here. Didn't really bounce back up in Friday's session, even with the advance. And we were flat to slightly declining based on volume, but we're still above the advancing moving average. So in the bigger picture, we're holding up. We're just seeing some weakness in the shorter term. Saw a little bit of an expansion of the new lows, a contraction of the new highs. So we're starting to go back down here with the 5-day. We've already been going down with the 10-day moving average of the difference. But still, overall, this is looking fairly strong. We're not seeing a big, huge growth in the red line going down. It's if anything, it's that the green line is contracting. We're negative now with the advanced decline ratio with the 19 period. We're below, that's the blue line. We're below zero, and we're just barely crossing below zero with the 39-day advanced decline ratio. We're negative with accumulation distribution, a smart money indicator. We dropped below the moving average on Thursday. We continue to be below that moving average. The chicken money flow, which also turned negative after Thursday. The red line's going down, and we're actually red negative here. So that's another smart money indicator that's negative. We're negative with the Chaikin oscillator, but we're dropping down to this pink line, which means we could be getting extreme negative here. And the vortex also switched from positive to negative after Thursday. Really no change in Friday's session. The red line is still above the green line, with the red line going up and the green line going down. Not much of a change here with the cumulative advanced decline line for the S&P based on price. A little bit of a decline. Didn't see a real bounce back up. When we look at this based on volume, we're also seeing a continuation of this decline. This is the 10-day average of the highs and lows for the S&P. We're coming down. We're just right at 90. If we drop below 90, this will no longer be extreme. And this getting a high reading usually means good solid momentum. Well, that momentum is starting to wear off now, and this is a little bit longer term type of chart. And we're still kind of matching up when we look at the S&P and the NYSE, where this is coming down a little bit more, even though they're on different scales. We saw the decline with the S&P, also the decline with the NYSE, but it was pretty much flat on Friday. And the cumulative advanced decline line for the NYSE dropped below the moving average, and we're starting to drop below the moving average here. Where this had been holding up before, we're seeing a little more weakness coming in, even with Friday's upward move. Dropping a little bit below the moving average here when we look at the other NYSE advanced decline line. Common stock declining based on price and volume here as well, even with the up day. And we're below the moving average now with the NYSE common stock when we look at the advanced decline line. We're right at the moving average with the S&P. Mid caps are a little bit above the moving average, where small caps showed a little bit of an improvement, but below the moving average. So we're not seeing across the board strength that we were seeing just a few days ago. When we look at the stocks inside of the S&P above their 20-day moving averages, we dropped below 50, so that's negative. We saw a little bit of a tick up here, but we're still negative with this chart. A little bit of a tick up too, but we're still negative with stocks above their 50-day moving average. So we're seeing a little bit more of a challenge to the intermediate term trend. We saw a little bit of a tick up. We're still positive with the 100 period moving average study and a bit of a tick up with the 200 period moving average study. So not much of a change here. We came down to the 50-day moving average and we've been above that. We closed below it. That's when the intermediate term trend will switch to negative. Excuse me. And we are still above average here with volume. Saw a little bit of a tick up with the 20, 50, and 200-day moving averages, but not anything really that shows strength. We're still extreme negative, even though we're coming up here with the Stochh RSI. A little bit of a bounce up, but still extreme with the Williams percent R. CCI 14 coming up, but still extreme negative, and the CCI 20 also extreme negative. Short-term stochastic, a little bit of a bounce up, but still extreme negative here. Still coming down with the intermediate term stochastic and could cross this green line, which would make it extreme negative. We're declining, but still above 50 here with the longer-term stochastic. After we came all the way down to the Keltner band, that's when we were extreme negative with the force index. We actually came back up, but we're still slightly negative here. This is the condition of the 20-period moving average as measured by a double and triple exponential moving average. We're below the blue line and the green line, so the lines are starting to roll over. That's showing weakness in the shorter term. We're also below the simple and exponential 20-period moving average here. We were not able to recapture that. And if you look at the bar here, it was an inside day where the low did not go below Thursday's low, but the high did not go above Friday's high. So yeah, it was a bounce, and we're still holding on to that 50-day moving average, but it wasn't a real, oh, let's go in and buy the weakness with a lot of conviction. It really fizzled out later. We're still negative here with the standard deviations chart. We're below the midpoint. The midpoint's starting to roll over. We're right on the border between the -1 and -2 channel. Intermediate term, we are still negative with the balance of power. We're below zero there. We're switching more negative with the go, no-go system. We're below the midpoint, and now the red line is starting to come down. Now, instead of focusing on the highest high value, we're looking at the lowest low value, which is the bottom end of this channel. TTM squeeze. It never did go positive, even when the S&P was going up. This was still trailing off, and now we've dropped below zero. So this is, instead of just going lower with the darker blue, now it's actually turning negative where it's showing red. The ease of movement below zero and declining, that's turning negative. We haven't seen a change in the Arun indicator. It's still positive. We're coming down here with the S&P McClellan oscillator. We ticked up a little bit, but we're still getting an extreme negative reading. Since we're below zero with the McClellan oscillator, that means the summation index is declining based on price. We're also continuing to decline based on volume. So no change there. The NYSE McClellan oscillator, not extreme negative, ticked up barely here, but we're still below zero, so it's negative. So we're declining with the summation index based on price and volume. And we saw a little bit of a tick up based on price with the Swenlin trading oscillator, but we're still declining based on volume. However, overall, this is still negative because we're below zero based on price and volume as well. Momentum has switched over to negative with the PMO going down based on price and volume. We're also declining. We had become just a little bit extreme here with the PMOs that are rising. We were getting extreme negative. Now we tick back up slightly. We're still declining with the buy signals and we're declining with the PMOs that are above zero. And we continue to be negative with the Elder's Impulse system. And you can see the open, the high, the low, we pretty much closed right at the open there. So not that was an up day, but it wasn't a real convictingly strong day. And we have now dots on top for the second day with the parabolic SAR. So that has turned negative. Slope, this is a short-term oscillator continuing to decline, will turn even more negative if we drop below the midpoint. The MACD is clearly going down, really with some rather intense movement to the downside here. So that's negative. All of our oscillators in the short, intermediate, and long term are now negative. So the momentum has switched from positive to negative. The Copic curve is also negative. The Sean trend meter coming more into this neutral area didn't see much of a change. And we're below 50 with the money flow, even though it ticked up slightly. We're continuing to decline with the ultimate oscillator below 50. That's negative. We came back up slightly above the moving average with on balance volume. So that's slightly a little more positive. We're still below 50 with the RSI 14 and 9, even though they did tick up just slightly. And this is the condition of the 50-period moving average. Now that's what we're focusing on. We're below both the red line and the blue line. The longer we're below them, the more these lines will roll over, and that will show a deterioration in the intermediate term trend. But we're still above the simple and exponential moving averages based on 50 periods. Until we drop below that, we're still positive in the intermediate term. Here's all the moving averages together. In the short term, we're below the 20s, so we're negative. We're still above the 50s. We still have the 100s and the 200s going up. Bullish percent index going down after crossing back below 70. This continues to be negative. Even with an up day, we saw this continue to go down. We're going down here with the NYSE bullish percent index after coming off of a very high reading. So that's negative as well. We also are declining, but still above 50 with the NASDAQ 100 bullish percent index. And after hanging on to these 20-period moving averages of the open, high, low, close, we're continuing to be below that. The longer we stay below this, if we do start to go back up, one of these lines may act as overhead resistance. We are negative with the Heiken Ashi with the black candles. We're negative with the Kegi chart, but we're pointing up with the up day. The Renko chart is negative with the red block, and the three-line break is now turned over to negative as well. The long term, we're below the red line here with the 150 and 200-day moving averages. So we are seeing a little bit of weakness here, but not really switching to full-blown negative. We're negative in the short term, according to the Keller market model. We're still positive in the intermediate and long term with the S&P mid caps, small caps, and QQQs. And no real changes here. We're negative in the short term with stocks, negative in the short term with bonds based on price in the short and intermediate term, still negative in the short and long term with commodities, negative in the long term with the dollar, where it's really been bouncing up lately. And so we see discretionary doing better. And a lot of that was Amazon was the reason for that. Tech saw a little bit of a bounce here. Healthcare, which had been a little bit weaker lately, and communication. We want discretionary, tech, and communication to keep doing better and actually turn over and look positive. That's where the market gets a lot of strength from. Where utilities were really down. They've been just screaming higher. Well, they've been really pulling back lately. So seeing a little bit of a Christmas look here where the positive open had the NASDAQ above 18.2, then it went down to 18.1. The Dow got above 42,000. We had a BPI cross below 50 for energy, so that's more negative there. The NASDAQ got back above 18.3. We saw energy having a 50-20, that's a death cross, a negative crossover there. Real estate is also seeing a BPI cross below 70 after it had been stronger. The Dow, after getting above 42,000, then went below 42,000. Industrials, which are more driven by the economy, had a BPI cross below 70. Communication had a BPI cross above 80. That's a very high reading, and that's quite positive. So if it can hang on to that, that would really help the market out. But if we see some profit taking in there, that could end up being more negative. We are negative in the short term with the trend model and the PMO. Looking at the decision point scorecard, we've also switched over to negative with the PMO in the intermediate term. No real disconnect here between the equal weight and weighted version of the S&P 500. The Dow, after dropping below its 50-day moving average, was able to get back above that. So that's slightly positive there. The diamonds have gone from negative to neutral for the Elder's Impulse system. The NASDAQ, and I know this is hard to see because we just started a new month with the pivot point. We're just barely above the pivot point. And that's kind of the line in the sand where above the pivot point we're positive, below the pivot point we're negative. So it's not really a surprise that we're just about at that point where the market is more indecisive. NASDAQ 100 also just a little bit above the pivot point right now, kind of at a tipping point currently. We are still negative with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still negative. When we look at the Qs, we're below the 20-period moving average, but still above the 50-period moving average here. Small caps, which were up 0.41%, but they're still below their 50-day moving average and still below this pivot point. But longer term, they're still in an uptrend when we measure that by moving averages. We are still negative, though, with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, we came up, but we're still below 50 with the RSI, still above the 50-day moving average here, but the momentum is still negative as measured by the MACD. Mid caps still above its 50-day moving average, and they were virtually unchanged, up slightly, up 0.16%. Still negative with the Elder's Impulse system for the mid caps, and the Wilshire almost came down to its 50-day moving average, was able to bounce up off of that. So this broader market measure is still holding up in the intermediate term for right now. We're also still above the 50-day moving average with the total US stock ETF. Chopping around, not really going anywhere decisively when we look at the staples to tech ratio. And the financial sector was up 1/3%, still above its 50-day moving average. The FANG index up over 1%, but pretty much going sideways lately, but still in a longer-term uptrend, still above its 50-day moving average. So we're still above this longer-term trend line. That support has held to this point, but we have not been able to break above this shorter-term trend line. Apple was down 1 1/3%, dropping below its 50-day moving average. Meta was virtually unchanged, still above its 50-day moving average. Nvidia was up almost 2%, also still above its 50-day moving average. Google, virtually unchanged, up slightly here, but above its 50-day moving average and kind of in danger of seeing a death cross if we drop below these moving averages. Amazon, this was the big story stock here, up over 6%, not setting an all-time high. And if you can see that chart, we closed well off of the high. We opened and then went up and then came down after that. Still very strong up day, but well off of its high for the session. Microsoft up 1%, still below the moving averages here. And we get another day or two of this, we might see a death cross here with Microsoft with the 50 crossing below the 200-day moving average. Tesla down 1/3%, but still above its 50-day moving average. Netflix, virtually unchanged, just chopping sideways. It was a week ago they came out with their just big or well-accepted earnings report. And seeing a little bit of an improvement here with when we compare on a short-term basis, U.S. stocks to world stocks, still showing a decline here on the longer-term correlation. Oil was up 1/3%, but still under 70. The dollar was up, still above its 50-day moving average, even though we're still in a longer-term downtrend here. And we were up. We really shot up with the 10-year yield. And that's spooking the market, to say the least. And we're going down with the 10-year based on price. And saw a little bit of a tick above the moving average here when we look at the Qs to S&P. Discretionary. And again, a lot of this was Amazon, where we're seeing a bit of an improvement here with this ratio. We're still pretty much on the moving average when we compare large cap growth to large cap value. So the large caps, this one looks like it's a little under the moving average, showing a little bit of an improvement with the mid caps and the small cap growth to value ratios. Just chopping around lately when we look at the S&P to utilities ratio, not really seeing anything decisive. And lately just been chopping around with staples to S&P, but overall this has been declining and that tends to be more positive. If we see this ratio really start to go back up, that would be more negative for the S&P. All right, so what's the outlook for Monday, the day before the election here? We are in the process of turning negative. Now, in the short term, we're already negative. The reason we're turning negative is because we're seeing our indicators turning negative, but we're still above the 50-day moving average. We're below the 20, above the 50. Weakness is continuing to grow. Even with the update that we saw, we didn't really see much of an improvement. And then we did have a lot of earnings report that came out, and Friday being the day that folks really reacted to the Amazon report. And then this is not updated here. So I will go to the next chart there. We want to keep an eye on all the geopolitical things going on as well. This is the calendar for the upcoming week. Monday session, factory orders, not a real impactful economic report there. We are going to get the ISM services, or they also call it non-manufacturing. And this has been above 50. We're going to see, can that still stay above 50 and show some growth there? Wednesday is going to be pretty light with the MBA Mortgage Applications Index. That's a weekly report. Then the big day is going to be Thursday with jobless claims, productivity, and unit labor costs. And then the Fed is going to come out with their decision. On Friday, we're going to get consumer sentiment. And here's a look at the calendar and what the expectations are. Seasonality, we're actually positive for November 4th. We're coming into a positive seasonal time. And from November into December. Doesn't mean we go straight up, and it doesn't mean we go up all the time. But typically, this is one of the best performing parts of the whole year. So we're positive across the board for November 4th. This is the Carson composite. This is showing that positive seasonality going into January, actually. And then the first half of November tends to do well, but the second half tends to do just a little bit better, going back to 1950. But these are the median 2-week returns, so they're really monkeying with the numbers here. Monday is most positive day of the week based on 2023. It's not the most, it's the third most positive day, but it's positive so far in 2024. We're seeing a real drop off here with the blackout period for stocks reporting their earnings, so they can't go in and buy their own stock, at least on a company level. So that is starting to become less and less relevant. And then this is another median measure from 76 to 2023, comparing a non-presidential election year with a presidential election year. And then how the market often will react coming into the market. You can often see some weakness here. And then after the election is typically when we see some strength, but we don't know what's actually going to happen. This is just what has historically happened. November through April tends to be positive. It's up 77% of the time with a 7.1% change. And probably after this, I'm going to switch this chart over to the weekly video. Also, I'll change this over to the weekly video where no matter how you look at November, it tends to be positive, whether it's since 1950, the past 20 years, the past 10 years, or during an election year. And then we do see some positive seasonality when it's an election year for the S&P, up 11 out of 18 times, down 7 out of 18 times with a return of 2%. And this will be going over to the weekly video as well. This is a new chart where it says November, December, and January are historically the best 3 months. So you get a pretty good return here, 4.4% for the month, and then also it tends to be up in December. No guarantees here. We're just going off what has historically happened. So what are the warning signs? We do have this confirmed Hindenburg-Omen with no changes to this point. We're keeping an eye on the defensive sectors, but they've been showing some weakness lately with staples, utilities, and healthcare. And then both the 5 and 10-day equity put call ratio, those are going up, and that tends to be negative. That means there's extra hedging going on, that folks are nervous about things. And we have our 3 smart money indicators: accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. They are all negative. The 20 period and 50 period moving average study of those stocks inside of the S&P, they are negative. Parabolic SAR is negative. The Swenlin trading oscillator the S&P and NYSE McClellan oscillators, with the S&P being slightly extreme, and the summation indexes are declining. The McClellan oscillators are more short to a little bit intermediate term, where this is more intermediate to even a little bit longer term with the summation indexes. Our oscillators in the copy curve showing that momentum is negative, the vortex is negative, ease of movement, money flow, and ultimate oscillator are negative. And we're keeping an eye on growth of value. Mid caps and small caps, downtrend. When we look at the S&P growth of value, not really breaking out, but not really breaking down at this point. We are seeing a bit of an improvement with discretionary to staples. Oh, and then the momentum for the NASDAQ 100 continues to be negative. On the positive side, kind of a short list right now. Now, I'm measuring the advanced decline line on where we are based with the S&P, and we're still just slightly above the moving average that we have plotted on that chart. And we are still positive with the bullish percent indexes for the S&P, NASDAQ 100, and NYSE, but they're all declining. So the context is that they're negative, even though they're still above 50. And the financial sector is still positive, and that's it right now. Okay, our conclusion, we are turning negative. We've already turned negative in the short term here because we're below the 20-period moving averages, but we're still above the 50-period moving averages. We do have that confirmed Hindenburg omen, and weakness is continuing to grow, even with the bounce that we saw on Friday, but we are still positive in the long term. Thank you. I hope you have a really nice weekend, and I will talk to you in the next video.